Hey, social media, it's Kinite McCrae, owner of This Is Why Inc., a Christian business building company that helps individuals and small businesses find their purpose and prosper in it. Listen, if you're interested in us supporting you with your business, why don't you head on over to www.ti-why.com. So for today's Money Matters Mondays, what matters in a minute, I want to talk to you about the difference between tax deductions and tax credits. So many small businesses and individuals contacted me because they don't understand the difference. And why is this so important? Because watch this. When you are filing your taxes, most businesses are so busy concentrating on reducing the gross income via tax deductions so that they can pay IRS the least amount of money, that they forget that when it's time to make a major purchase, such as a house or a vehicle, that now their income has been reduced so low that when they go to provide those financial statements to the lenders, such as tax returns, their income is too low to even qualify. So I want to share with you some of the differences so that you will have a better understanding of how you can reduce your tax liability to IRS without necessarily reducing your income, so that you can still maintain a healthy financial position so that you can qualify when it's time to make a major purchase. So what is a tax deduction? A tax deduction is an expense, an allowable expense that is deducted from the gross revenues or your gross income. And so what it does is it reduces your gross income, thus producing what's called your net taxable income. So an example of that is, let's say you earned $50,000, you had $5,000 and allowable deductions, and now your taxable income is $45,000. Well, your tax credit is an amount that is deducted not from your gross or net taxable income, but it is deducted from your tax liability. So let's use that same scenario. 50,000 in gross income, $5,000 in allowable deductions, $45,000 net taxable income, and let's hypothetically say you owe IRS a $5,000 tax liability on the $45,000 net taxable income. Well, if you qualify for tax credits, let's say maybe the child tax credit, which allows you up to $1,000 per qualifying child dependent. So if you owe IRS $5,000 tax liability and you qualify for the child tax credit, that $1,000 gets deducted from the $5,000 tax liability. Now you only owe IRS $4,000. Again, this is so important because so many business owners focus on tax deductions so that they can reduce their income and pay the least amount of taxes, not realizing the impact it has on them when it's time to make a major purchase. Listen, I hope this was helpful to you. And keep in mind, if you want help to understand your financial picture or to make sure that your business is running on the right track, give us a call at 703-997-9203 or email us at info@ti-why.com. I'm Kinite McCrae with This Is Why Inc. for Money Matters Mondays, and this is what matters in a minute. Until I see you next week, have a blessed and prosperous week on purpose.